Hello, we're going to show the output data from the B2T engine on the FDII deduction, or the FDII deduction. If a U.S. company earns intangible income from a foreign source, it may be allowed a tax deduction from that income. This is the FDII deduction, or the deduction for the foreign derived intangible income. We know that if a company moves its intellectual properties or its operations overseas to take advantage of lower taxes, that income may be deemed to be distributed to the parent company and be taxed by the IRS through the mechanisms of Subpart F or GILTI. These are to discourage the U.S. companies from moving to foreign countries. The IRS also encourages a company to keep its IP in the US by offering the FDII deduction. That is, for example, if the company chooses to keep its IP in the US and earns income from foreign countries, then it may get a deduction on that income. The calculation of FDII deduction is formulaic and logically not immediately obvious. But the B2T engine will handle that automatically as long as the user maps his accounts to the standard accounts and provides the relevant income source country information. Here we're going to use a simple example to show the output data that are relevant to the FDII deduction. So let's take a look at our simple example. Here, we want to calculate taxes for a U.S. company P that has a revenue of $1,000. Here, we also tell the engine that there is an entity group where the parent is just the P and that group has just one entity. So that's the very simplest case. And we further tell the engine that we do want to calculate the tax obligation of that group. Now, this would trigger the engine to calculate the items of international taxation, which includes the FDII deduction. So let's take a look at, in the simplest situations, what would the engine do? We go into the recurrence sheet, which has that easy button, and we're going to submit it to the engine for the calculation. So the engine is starting code. It may take a few seconds to warm up. It's done. So let's go to the output file. So here's the output file. We see the engine calculation. We're going to look at the P calculation for P. And we go to take the shortcut to the provision sheet of P. So here, the very first thing is the current tax expense for P, where we see a bunch of international items under the special items section. FDII tax benefits from the deduction is listed as 0. Now, we wonder why, how that was arrived. Okay, so we go down, these are the various reports, and that's not our interest. Subpart F not our not we are looking for. The GILTI is not we're looking for. We're looking at the FDII calculation for P and its USA tax. Now at the taxpayer level, let's see how that's calculated. Let's go down very quickly. So the first, it calculates the deemed intangible income, which the deduction eligible income is 1,000. We don't have any fixed assets like assets, so it's 0. There's no depreciable intangible assets. And the return on it is assumed to be 10%, as specified by the IRS. So the deemed tangible income is not there. So taking the tangible income out, the rest would be the deemed intangible income, which is 1,000. So we do have an intangible income. However, the next section, we look at foreign derived income is 0 because we had only that $1,000 income, but we don't know it's a foreign derived. So therefore, the foreign derived ratio is 0. So therefore, the FDII income before any consideration of income limitation is 0. And well, therefore, it is 0. When you have 0 income, a portion of it is still 0, so therefore the deduction is 0, and so therefore the tax benefit from that deduction is 0. So that's why we get early on the FDII deduction tax benefit is 0 in our current tax calculation. So now let's say that the company P does have $200 out of that 1,000 is derived a foreign country. Let's see what's going to happen in that scenario. So we're going to close this output file and go back to the input file. So we wanted to tell the engine that for this 1,000 income, there are 200 of it, or 20% of it, is foreign derived. And we can specify an allocation for that purpose. So we're going to drag it over, take a look at a property over there. I'm going to float over there. And somewhere down there, there's a US FDII foreign derived deduction eligible income allocation. Okay, so we're going to allocate 20% of the 1,000 as foreign derived. There are other ways, but for this purpose, for this tutorial purposes, we're going to use that mechanism. So the property is US FDII underscore foreign derived deduction eligible income allocation equal to 20%. Okay, so that's it. We told the engine just that it has 20% of that income is from is foreign derived. Now, with a FDII means a foreign derived intangible income. So let's also tell the engine that a P actually has some tangible assets. So therefore, some of the income is from tangible assets. Let's add one more record to tell the engine just that. So we added a trial balance to tell the engine that P has an account fixed asset balance is 800. And clearly we need to tell what exactly this FXD asset account is. So we go to the setup input, and we're going to add an account mapping record over here to tell the engine just that. So here we tell the engine that this fixed asset account is actually mapped to the standard fixed asset. So that's it. So we're going to save it. And we're going to go over to the recurring input sheet, where on top we have the easy button. We're going to submit it again. So it's down. Let's go to the output file again. Now this time the number is a little bit different because last time was a 210, the standard 21%. Now, so we go to the provision sheet for P again, and we go down to the current tax calculation for P, and we see that it's a deduction tax benefit FDII is 14 credit balance, which is a benefit, 1449. So how was that calculated? Remember, we told the engine some information about foreign derived as well as tangible assets. So let's say how those information were taken into account. So here's our FDII calculation down over here. Okay. So now for that at that, we have only one provision calculation. So a lot of the basic inputs for the FDII calculation is all from that one single provision. Okay, we have the deduction eligible income. When you have the out of that, how much is foreign derived, and a QBI qualified business asset investment, which is tangible depreciable assets, is 800. Those numbers look very familiar, so we kind of go to detail just to see how those numbers were obtained from the account balances. We go to the detail sheet for P. Okay, so we go down to the FDII related calculation by account. So in that section, from the trial balance, we see the revenue contributes to deduction eligible income, and it contributes to foreign derived deduction eligible income, 200, right? We tell it tax percent, and in fact, Engine tell us here the user foreign derived number allocation is 0.2 on our balance, so therefore we got a 200 over there. So it says that, and a fixed asset contributes to the QBI, which logically makes sense. And there's nothing from the book to tax adjustments contributes to the FDII basic numbers, and the two parts combined together that we got the final answer. So therefore, for that provision, we have those basic numbers, and those basic numbers, we have only one provision to calculate, so therefore they are the same as the taxpayer level. Okay, so the aggregation of that one thing is just that. So therefore, we take a look at the taxpayer level. We have the DEI, deduction eligible income, is starting with 1,000. We have the QBI, and in a 10% return on that, we get 80. Okay, so these are the tangible income, deemed tangible income. So the intangible part of that income would be 920. Okay, and we further down the next part, foreign derived deduction is 200, as we calculated earlier. And so therefore, the foreign derived ratio is the 200 over 1,000. 200 over 1,000, so therefore it's 20%. So the FDII income, foreign derived intangible income, is 20% of that is 184. And we see that it cannot be more than the total taxable income, which is 1,000. So it is the FDII post income limitation is still 184 because it's within the limit. And 37.5% of that is our deduction, which is $69. That amount of deduction at a tax rate of 21%, you would get a benefit of $14.49. So that's where the benefit comes from in our current tax calculation. CTE calculation for P, 1449. So we see the engine takes care of a lot of details. To summarize, the user only needs to map his accounts to the standard accounts, such as a fixed asset. And he needs to specify any foreign source country for the income or expense account balances. Then the B2T engine will automatically perform the calculation for the FDII tax benefit. That's it. Thanks for watching.